I don't know what that really portrays for the future, but I will tell you that I think we are a long way from seeing the top in gold and silver. And what you did see was a flushing out of all the speculators. And now the metal is held in very strong hands with very low open interest on Comex, with deliveries that continue every single month. And in gold, we've seen 18,647 gold contracts, or 1,864,700. Would that be right? Yes, that would be. Ounces of gold. I mean, in both cases, you're just under $1 billion 2 weeks into the month. By the end of the month, just like every other month, will be well over $1 billion delivered.
The recent shakeout in gold and silver does not alter the overall market outlook. It has removed short-term holders, leaving control with long-term investors. The key message: this strengthens the market's foundation and shapes expectations for its direction. Andy Schectman, a respected voice in the precious metals market, emphasizes that the market is far from peaking. He cites low Comex open interest, steady physical deliveries, and ongoing withdrawals as evidence that the real action is behind the scenes. For long-term buyers, these trends indicate positioning, not reaction. The forecast relies on tightening availability and continued accumulation, suggesting the overall trend remains upward. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Waiting to that degree to time the market specifically, perfectly, and I say this with respect, arguably can end up being a fool's errand. Penny wise, pound foolish kind of thing. I get it. You know, when you talk about a market where some dealers would be reluctant to hold larger positions of gold than they normally would, well, that has a lot to do with the cost of holding said gold, with the margin increases that we've seen and the risk involved. Unfortunately, as the price gets higher, the risk becomes higher for clients who decide to cancel or walk away from an order. I think a lot of people are under the misconception that, well, they have it in inventory. What do they care if I cancel? Because if you are one of the big companies, you're hedging your inventory. And that's the point. If you hedge your inventory, the higher the margin costs go, the higher the cost for hedging, well, you may not be willing to hold as much. And if you have a hedge position, you unwind the hedge when the purchase is made and put on a new hedge until that purchase is paid for. If they say, forget it, and the price goes against you, it opens up the dealer to tremendous losses. And it's a problem. There are people out there, unfortunately, for every 2 or 3 good people, there might be one person who doesn't honor their word. And that can put a company out of business very quickly. It's very important to understand that the risk involved with running a company has never been higher, ever, in terms of costs, and in terms of clients who don't pay up front and then back away. We never ask people to do that unless the order is massively large and we've never done business with them before. But I can understand the company's motivation for saying that. It probably tells you that they've had some canceled orders that have stung very, very badly when people don't honor their word. It's important to understand that when you are locking in an order with any company, that is a contract. That is a deal where they are, in most cases, if they're a larger, sophisticated company, hedging that trade against your word, not making you deposit it first and then expecting you to pay. When you don't pay and the market moves against that company, because they are taking a short position against it, their losses are unlimited the higher the price goes against that position, or the lower if it falls against that position. Rather, it puts them at a very, very, very bad bad place, and I think that's probably part of the issue. But even taking a step back from the nuances like that, I will tell you that, look, we've talked about it ad nauseum. There's not enough metal out there to handle even a 10% increase in demand, 20% increase in demand. That just like that, everything's disappearing. And that's the reality of it, is that this is a market that for the gold bugs and the hard asset people, which are the pimple on the elephant's rear, sure, there's enough challenges. Quite often, we've seen it. Getting product becomes very challenging. You open this up to a larger awakening by the public, getting product will be the most difficult thing, period. End of story, 100%. We're not quite there yet. because this last round of margin increases shook out tremendously a lot of the speculators, a lot of the people who, once again, come into the market for the wrong reason. They're coming into profit. I think when things start to change, when it becomes more concern, fear, I need to protect myself, I don't care about making money, I just don't want to lose it, that's when you'll begin to see those types of realities. And when you talk about a silver to gold swap, again, how many people are waiting to do that same trade? So instead of doing it all at once, it would be better to, like an onion, layer it as the price starts to get into a range that you're comfortable with. Start layering your trades. These are very, Donegan, I've never seen more challenging, difficult to explain and understand markets than we have right now in a market that should be very straightforward. And I think that in and of itself is an indictment to the system, where things are happening that we don't normally see, all the way from deliveries that continue unabated. We've never seen that before, to margin increases. We've never seen that before, to selling junk silver at $2 under spot. We've never seen that before, to bid prices dislocated the way they are. We've never seen that before. I don't know what that really portrays for the future, but I will tell you that I think we are a long way from seeing the top in gold and silver. And what you did see was a flushing out of all the speculators. And now the metal is held in very strong hands with very low open interest on Comex, with deliveries that continue every single month. Here we are again in April. Let me just give you the April numbers here real quick. The April numbers, which we're only 2 weeks through, are, bear with me, shouldn't take me but a second, I hope. Here we are. In April, silver withdrawals have been monstrous since the start of the year. 135 million ounces in Q1, plus 4.236 million ounces so far here in April. These amounts do not include the 8.260 million ounces issued and stopped on the Comex in the April delivery month so far. And in gold, we've seen 18,647 gold contracts, or 1,864,700. Would that be right? Yes, that would be. Ounces of gold. I mean, in both cases, you're just under $1 billion 2 weeks into the month. By the end of the month, just like every other month, will be well over $1 billion delivered. And if we look at February, we're at 36 or 37 or 8 million ounces left Comex, 160% of what was delivered. You're beginning to see it increase. And this has happened in the face of falling metals, rising interest rates. It doesn't matter. These big players, they don't care. But the mainstream media wants you to think that's all that matters. Oh, yeah, the Fed's not going to cut rates, so that's bad for gold. But they don't talk about the fact that for a year when rates went from 0 to 4%, gold still skyrocketed. The largest increase of rates in history in terms of shortness of time, and yet gold still took off. The media is getting it all wrong. And when the media is telling us that, well, war creates higher energy, which creates higher CPI, which creates more inflation, which means the Fed can't cut rates, that's bad for gold. It's just a bunch of crap. It really is. And the big money shows you that by how much they're taking in possession. Look at China. In the month of February, when silver was getting its teeth knocked in, imported more silver than in the history of recorded supply-demand numbers ever. In the month, as the second largest producer in the world, they're importing the most they've ever reported since they've been keeping records, ever. So price is a tool of misdirection. The big money uses it and the shaking of the trees, the deleveraging of the trade to their advantage. And they stand for delivery when everyone else is looking elsewhere.
Another key idea is that trying to wait for the perfect entry can become a costly mistake in a market like this. Physical metals do not behave like ordinary commodities when inventories tighten and delivery demand remains strong. Price dips may look like weakness on the surface, but beneath the surface, they can reflect a transfer of supply from emotional holders to patient buyers with deeper conviction. The discussion suggests that rising margins, dealer risk, and tighter hedging conditions are already changing behavior across the market. That matters because it shows stress building behind the scenes, even when headlines remain focused on interest rates or temporary price pullbacks. The prediction here is straightforward. If demand expands even modestly, product availability could tighten very quickly. In that kind of environment, the challenge may not be deciding whether to buy, but whether metal can still be sourced easily at the quoted price. This is why gradual accumulation now appears more important than chasing the perfect moment later. Let's get back to the interview.
The deliveries are all you need to know. As I've said every time I'm on your show for the last few months, it's all that matters, because these people, not just the central banks, whoever the hell's doing it here in the United States, who's doing it in Shanghai, who's taking deliveries in London, all of these entities that are doing that are highly sophisticated, incredibly wealthy, and have the ability to not only stand for delivery, but to run logistics. Like in February, who took 2 million ounces of silver out of the Comex? Where did it go? 2 million pounds of silver, 39 million ounces. Who took 2 million pounds of silver and ran logistics for that, and where did it go? But this is a pattern that is not slowing down, and that's all people need to see. That's all people need to know. The rest is noise. The rest is complete and total noise and poor reporting by the mainstream, who would tell you gold is dead, and gold no longer has the inverse correlation to the markets because, well, the S&P fell, but gold fell more, and it's got a higher beta. And nonsense. That's nonsense. That's mope. That's management of perception economics is what it is. And yes, there is a reality and truth to the fact that probably some gold was sold to rush to liquidity. But it also gives them the impetus to pile on and to knock it down, to make it seem that way, and then stand for delivery at subsidized prices. So, I don't know, Dunnigan, it's confusing, but it really isn't if you take a step back and say the people who are standing for delivery are very sophisticated and very well informed. Maybe that's the path we should look at. When you're working on a just-in-time inventory and rely on sources, not just in the United States, but globally, things can change at the blink of an eye. When you blow through an inventory that you've never had a hard time replacing, all of a sudden it's impossible. And we've seen that together, you and I have on several occasions. So it's not grandstanding, it's not being sensational, it's just being real. And I get it. Again, I'm sure people get tired of hearing this. I get tired of saying it, but it doesn't dismiss or change the reality. The players that have been able to keep this ball up in the air always seem to have the ability to keep it up longer and more impressively than people think. But in the end, mathematics will catch it. Mother Nature will catch it. And when that happens, you're too late. The hurricane is knocking on your door at that point. So you don't buy it to become wealthy. You buy it because it is wealth. And the only thing that matters is that the most well-informed traders on the planet, who are the wealthiest, the central banks and whoever's doing it off of the exchanges, which are incredibly wealthy and sophisticated, that's all you need to know. That they don't do this for the hell of it. They do it because they know where the puck is going, like Wayne Gretzky always did. And that's why he was the greatest hockey player ever. Never skated to the puck, skated to where it's going. And that's what they're doing right now. And no one notices that because they're, the mainstream media not only has been wrong, and wrong again on why the markets are doing what they're doing. And you get these guys saying it's now lost its inverse relationship and it's not the safe haven that we thought. Well, that's what they want you to think. If that were true, then why are they standing for delivery? Why did China import more silver in the month of February after it was getting destroyed, the price of silver, than in any time in recorded records? Why? Because the big money knows where the puck is going, and they're using the stupidity of the Western paper market to bleed dry the whole system. And one of these days, that all-at-once moment comes when there's not enough to be delivered or no desire to sell products minted in the UK or in Australia or in Austria or South Africa. Send it to the West. Why? That's coming. That would be next. So yeah, I think waiting is a fool's errand. Better to do things at least incrementally, cost averaging, smooth out the uncertainty, but don't bet that you're right. Even when you're right, you can be wrong because of the inventory supply problem.
The broader takeaway is not simply that gold and silver could rise, but that the market structure may be changing in a more meaningful way. The interview points toward a growing divide between paper narratives and physical reality. Mainstream explanations keep tying metals to rate cut expectations, inflation headlines, or short-term sentiment, yet physical deliveries, strong hands, and aggressive accumulation continue to tell a different story. The core message is that informed investors are moving early. When large, sophisticated players take physical possession during periods of volatility, they prepare for future changes that are not yet reflected in public discussion. The real opportunity comes when the public recognizes supply constraints and gold and silver's role as true wealth, potentially accelerating the move. This conversation frames precious metals as long-term protection, not just quick trades. Once market repricing is clear, the easy opportunity may have passed. Share your thoughts in the comments below. If you found this analysis useful, please like this video, subscribe to the channel, and turn on notifications for more updates.